Hello everybody, Luke Gromen, FFTT. Hope you are well and having a great week. Gonna jump right into the questions. As always, thank you for submitting questions. Thanks for joining me. First question is from SC. You've mentioned recently that the USA runs the risk of becoming Argentina with US characteristics, but not like Japan. Why Argentina and not Japan? Can you expound? Yeah, so it's important to look at the United States versus Japan from a current account basis. So Japan runs a surplus, U.S. runs a deficit. From a domestic financing standpoint, so the U.S. is heavily, at least historically, foreign financed. That is not true for Japan. They domestically finance their own deficits, their own fiscal deficits. The net international investment position of the United States is negative 65% of GDP. Japan, it is positive 60% of GDP. And the U.S. Essentially provides a large portion of Japan's defense for Japan. That is not true for the U.S. We provide our own defense, which has a very expensive cost to it. So the reason why that layers or shakes out as the U.S. being more like Argentina with U.S. characteristics and not Japan in response to a debt problem is, first off, the net international investment position. Japan has the option of selling its foreign assets. It can call up Washington, say, give me my dollar assets back, and do so and finance itself for quite some time. The United States has no net assets to do that with. They can't call Japan and say, give me my net assets. We don't have any. The net internet, that means that immediately when you have a debt problem to finance, right? So we see the yen at 150 and trying to break out. JGB yields rising to problematic levels. Japan can sell treasuries, buy dollars, take the dollars, sell the dollars, buy the yen. And they can do that to the tune of 60% of Japanese GDP before they run out of money and have a full-on currency crisis. The United States has no such option. The option is the Fed does it or it doesn't get done. And if the Fed does it, it's going to be inflationary, as we have seen in the last several years. The domestic ownership of treasuries. Japan can get away with deflation. Japan has financed their deficits from internally. They can pay basically 0% rates because they have domestic deflation. So real rates are still positive. The math has worked for them for a long time. For America, we have such a huge side of our given historical foreign ownership of treasuries, right? They own 7.6 trillion of treasuries. We can't pay them zero. They do something else with the money. So we have to, you can't, once your debt gets that high, a positive real rate drives a debt crisis, as we're starting to see. So the U.S. is night and day. It basically, in every critical respect, it's 180 degrees opposite of the Japanese situation. And that's why I think it is likely to be much more like Argentina with U.S. characteristics, which is to say a sustained period of high inflation, probably preceded by some form of crisis in the debt markets. But ultimately, the Fed is going to have to act to help finance the Treasury. Next question from BlackRock CEO on TV this week talking about crypto. He means Bitcoin being a flight to quality. Does this strengthen your opinions on Bitcoin, or should we be wary of such comments by these CEOs? To me, I think it signifies a growing recognition amongst the policymaker level class, if you will, that for the first time in any of our careers, anyone alive's career really, the risk-free asset in the world, treasuries specifically, Western sovereign debt more broadly, has either significant inflation risk or credit risk. In other words, if their central banks don't print the money, they will eventually, in the not too distant future, have credit risk on their sovereign debt and on treasuries. And what I mean by that is specific to treasuries, there is a rate where U.S. inflation, or excuse me, there is a rate where U.S. interest expense goes above tax receipts. Where is that rate? That's a $64,000 question, but it ain't 15%. It's probably not 13%. It's probably not 10%. And so, given that we're already over halfway there, once your interest expense is above your tax receipts, and I would argue that entitlements are interest-like expense, but let's just keep it very strict definition. Once your interest expense is above your tax receipts, you either print the money to pay the interest or you default. And so that is a dynamic where if central banks don't add the liquidity, if the Fed doesn't add the liquidity, this bond market sell-off isn't going to stop. We've talked about this. The higher the dollar goes, the more net effective selling of treasuries is going to be into the markets. Beatings in duration will continue until the dollar's weakened. So if you need a much weaker dollar, in order to not lose money in bonds and ultimately to make sure they remain nominally solvent, then you should start to be looking to shift some assets to some money to assets that don't have counterparty risk, that better hedge inflation risk. Gold, Bitcoin. And I think the official class of policymakers at that level are starting to sort of see that. And if you read some of the headlines and talking about the bond market, some of the things we've been writing about in some of these articles, citing some of these articles in the Journal and the FT and Reuters and Bloomberg, they're not quite there yet, but they're getting to points. These policymaker class are getting to points where it's not that far a leap from where they're currently standing to, oh my gosh, the only way we can keep this Western sovereign debt nominally solvent is by inflating it, in which case you need to own some gold, you need to own some Bitcoin. I think they're getting close to seeing that. From SB, you've spoken of the bad incentives the international role of the dollar creates for U.S. government's foreign policy. If, as many believe, the U.S. government needs a higher price of oil, would a giant war across the Middle East be welcomed by some factions in order to extend the dollar's timeline as currently structured? I don't know that anybody wants what's happening to happen in Washington. I do think it offers cover for inflation, which the Fed desperately needs. They desperately need a scapegoat where they can say it's not our fault. Or we're backing off on rates because it's the right thing to do for our allies in the Middle East. I do think the U.S. wants higher oil to keep shale production elevated and deep water production elevated. But they also want lower oil to help stabilize the treasury market. Because again, once oil gets high enough in price that it pushes U.S. foreign creditors that import oil, China, Japan, Europe, into a current account deficit position, like it did last summer, like it probably is right around now, above $95. Those current account deficits have to be financed by Japan, by China, by Europe. How are they financed? They're financed by selling treasury bonds. The treasury bonds, the piggy bank, all these countries own, these creditor nations own, they'll sell them to raise dollars to finance their deficits, to defend their currencies. So Washington needs both a higher price of oil, the energy side, the strategic side, and the immediate sort of four-alarm fire in the bond market needs a lower price of oil. So that makes it tricky because A, war is inflationary, and that's a great quote from Zoltan Pozsar, but B, higher oil prices from this Mideast war is likely an accelerant to the bond market sell-off we're seeing in treasury markets and across bond markets. So I don't think anybody in Washington really wants this. This is it's a pretty bad time for it to be happening for Washington, and I think we're seeing that at the long end of the curve today. And it's today being Wednesday, it's like I said, it's likely going to continue until the U.S. dollar is markedly weakened. And then the final question: if China were to start a military war, would rates go up or down? A lot of different implications to think about, such as flight to safety for assets, which people would buy treasuries, and also reduction of goods available for everyone, which could spike inflation. I'll preface this with I think it's an interesting thought exercise. I don't think it's going to happen. Take that with a grain of salt. I didn't think Russia would invade Ukraine. It was totally wrong. With that said, rates would in the U.S. and across the world would probably spike a lot. The bond market across the world would probably crash. The flight to safety in asset markets would probably be gold, oil, commodities. Probably Bitcoin, probably big cap stocks. Perhaps in the U.S., maybe not though, because wars are expensive and inflationary. People are going to want their capital, and their capital, remember, 2/3 of global equity market cap, give or take, maybe it's 55, maybe it's 60%, but the majority of global equity market cap is in U.S. equities. So if there's a war where the world bifurcates and people want their capital, they're going to take their money out, not put it in. At least some of it. Maybe some of it will come, but a lot of it's going to get pulled out, depending on where the conflict is, et cetera, et cetera. Goods would also be likely a bid to safety. Because remember, if you have a war with the world's factory, the shortages and the inflation we saw in COVID will be a cute warm-up to what we see, which is why I think the bond market across the world would crash instantly. I mean, remember, World War II, long-term treasury yields were at 2% when Japan bombed Pearl Harbor. Instantly, they went to 2.5%, and then the Fed capped them, said, yield curve control, we're not going to allow long-term bonds over 2.5%. And that's where they stayed for the next 9 years. And you got paid every dime you were owed, and you lost a lot of money on a real basis. Stocks did well. Commodities did well. But again, everyone loves speculating in commodities in a war. That's not going to, that becomes a threat to national security. You're going to have some sort of capital controls. You will have rationing, copper drives, rubber drives, etc., that kind of stuff when you're talking about major power war, global power war. So some thought process on it. I think it's an interesting thought exercise. I think it's important as a tail risk, as something to spend a moment thinking on, but I'm not dwelling on it. I just think it's so catastrophic that I like to think that cooler heads would prevail. Maybe I'm being optimistic, which is ironic since I'm sometimes called a doomer by some people. At any rate, as always, thank you very much for joining me. Enjoy these conversations. Everybody have a great rest of your week. If you like these updates, check us out, FFTT-LLC.com. More information about what we're up to, as well as our Tree Rings product, 10 most interesting things. Brief synopsis on what grabbed our attention about them, whether they refute or support a way we'd previously been thinking about the world. So everybody have a great rest of your week. Look forward to chatting soon. Take care, everyone.